April historically is one of the best months for the market. It's not news that that did not happen this year, and there are some pretty reasonable answers for that. Thanks for joining me on Sky Blue Wealth, our monthly recap where we talk about the economy, the markets, and what it may mean to your investment strategy. I'm Eric Powers, a certified financial planner, and today we'll talk about the effects of the supply chain slog. Okay, so let's get into it. First, let's talk about the economy. What is the objective of our biggest bank, our central bank, also known as the Fed? Well, of course, it's to help, not hurt, our US economy. And periodically, they do have to take actions that incur some short term pain that we're feeling right now as interest rates are being raised. As interest rates go up, by the way, that is also known as tightening, or sometimes it's called hawkish. So why are they raising rates? Well, it's to cool inflation so that things don't get too expensive too fast. And there is a good chance we're probably going to see inflation go up another 2 or 3% from here before the end of the year. It really is a balancing act. They're doing their best to be able to tame inflation and bring that down, well, hopefully not cooling the economy too much or forcing us into a recession. Inflation, even though it seems to have a bad connotation to it, isn't always something to be scared of. One good thing about inflation at home is increased wages. Maybe you've already received a raise, but many companies have already increased wages and they expect to do so again before the end of the year. One of the primary causes of inflation is actually this supply chain mess. Getting any product from point A to point B is a nightmare. Also, war in Europe and energy threats that force up the costs of oil and materials. Currently, inflation is running hot, too hot, and will likely come down probably to around 4% by the end of the year. We don't think we're in a recession, and we also don't think that we will be before the end of the year. Now let's turn to the markets, which don't seem to be in our favor at the moment, of course. Previously, we've seen lots of gains. The stock chart was going up and to the right, and it seemed like there was no end. We are having to reconcile that some now. Remember that the markets are actually forward-looking by about 12 months. So they're pricing in today what it is that they expect corporate earnings, to really look like a year from now. Now, one thing that can really upset the market are surprises. Markets don't like surprises, and they cause volatility because of the uncertainty around them. So they come in all varieties and flavors. Currently, the headline terms are inflation, politics, war, but then there are the others too. There's like credit and there's taxes. All of those can make headlines from time to time that the market has to interpret. Something we really like to keep an eye on is where we are in the market cycle, or where we believe we are in the market cycle. Now, what typically happens with these market cycles as they rise to a peak and fall to a trough is that sometimes they overshoot on either end. Right now, it could be that we've overshot and we've had excess market losses. I wonder if you've ever heard this expression, sell in May and go away. What does that mean? Where does it come from? I don't know exactly where it comes from, but it probably means that there's a lot less market activity during that time. Maybe there's money on the sideline because people are on vacations. I don't know exactly. But what it means is we're headed into the weakest 6 months of the year. If you've looked at your portfolio lately, you notice that you've got a lot of red in a lot of different categories. Stocks and bonds have both lost. Bonds have not been that safe haven or the safe place to hide that it's provided in the past. Bonds are not typically tied to stocks, meaning they don't usually move in the same direction. They usually are inverse from one another. But the cause for the bond losses is the rise in interest rates. And we will continue to see rises in interest rates throughout the end of the year, as we spoke about. That will continue to keep pressure on bonds. The Fed will also be selling bonds in the near future. You remember the old term quantitative easing? We've actually been quantitative easing for a very, very long time, but now they're flipping to the other mode, which is quantitative tightening, or other jargon would be running off the balance sheet. As we talk about the headwinds the markets are seeing right now, we can't ignore politics. Even though we haven't really started to talk about midterms yet, we are in a midterm year. And midterm years typically have a choppy 3 quarters, the first 3 quarters of the year. On the plus side of things, for you stats people, the 10 worst starts of the year ever, good news here, is that the rest of the year is up by 10% on average. And I'll say it again for those who are really into statistics, the worst 10 starts of the year usually end up 10% on average. And we're hopeful and optimistic that we'll get those back-end loaded returns. Now this is compared to the front-end loaded Fed interest rate hikes. They are going up now, and they'll probably go up next month, and then maybe they'll slow down for a little bit. So as we look to individual portfolios, we're still in favor of stocks over bonds in an allocated portfolio. We favor domestic stocks, and we are tilting portfolios a little bit towards the defensive side. And with that, we'll wrap it up that things may not be comfortable right now, but the world is not ending. Don't forget to follow this channel or reach out to us for help.